So we're back here coming into earnings, and not much has changed in the position since yesterday, but let's just go through this real quick, what we're looking for, and I'm probably going to take some of this off coming into earnings. Now, one of the best ways to kind of analyze our position when we are looking at stuff in Thinkorswim is if we go to the Analyze tab and we hit Risk Profile, it's going to show us visually a snapshot of our risk here. And so sometimes you got to pull stuff around to get it to the right, so that there's enough room to actually see here. So let me try to pull this all down a little bit. So here's a great viewpoint here, if I get out of the way, that kind of illustrates the situation, which is basically, since we're right before expiration here, it's very clear. I make money if this, if I leave the position the way it is, if on Friday expiration we're between 190 and 230, I make up to $6,000. Below 180, the situation starts to deteriorate, and above 230, it really starts to deteriorate. So let's see if we can, if I hit Control and hold the mouse, I can move stuff around here. So look, up above 250, all of a sudden, I can lose the whole account value if we get up to like the 300s here, right? So this situation here is not good, right? Above 240, I'm really hurting here, right? So I want to try to address this somehow today, and the ways to address it are either to take off some of these call spreads that I'm long, or buy some out of the money call spreads to kind of affect this, because that's not good. Now, if we do look at the downside here, things are it's a lot better situation, right? The worst spot is this 150 area, but after that, if we were to really crash down to 100, we do really great. They are expecting a move of 12%, so that's like right in this range somewhere. But this is pretty extreme here, and my feeling is I probably want to pare this back somehow a bit. This was decaying sort of every day, and I did make $700 on the position yesterday, which is great, but this might be kind of too extreme of a situation for us to deal with right now. Now, if we move forward a little bit, so anyway, so if we want to look at this and see how different things will affect us, what we can do is we can try different things and see what the difference would be. So, for example, if I were to go in here and let's say I go in here and I say, okay, well, what would happen if I take off some of these short call spreads to the upside? So if we look in here, we can see I'm short 11 of the 225, 235 call spreads. So what I could do is click on the offer of that option, then hit Control, click on the bid, queue up buying some of these in. So I'm going to queue this up. I'm going to right click and I'm going to hit Analyze Trade. Now this is going to bring down this possible trade into our Analyze tab here. So if we go down here, you can see it. And so thus this is going to affect our position, and it's going to affect our chart too. So if I were to, let's just take a look. I'm short 11 of these. What if I were to take all 11 of these off? How would this affect our chart? So that's what I did there. I took all 11 off. Now I'm going to pull this back down so we can see the chart better. Now all of a sudden we are in positive ground all the way up to 290, right? But our potential upside is not as high as it was, right? We still make $5,000 here, right here, but as it moves up, we lose money, but less, right? So that's good. Now the other potential hole here is down here, right? This 150, 160 area. And the reason for that, of course, is we're short spreads down there, right? So let's take a look at that. And how could we, it would be nice to just kind of level this out, right? Not make maybe as much money down here, but not lose as much money here. So how could we potentially do that? And, we don't really want to buy everything back in because that's going to take away a lot of our profit potential. So what if we were to buy half of these calls in these front month calls? Well, we'd still have problems, but our problems start a little bit higher. And we have some other stuff that we're short also. The other potential thing to do, and it kind of depends on where prices go, but another thing we could do is we could, instead of buying these in, we could buy something out of the money. So let's say we bought the 250.60 call vertical, right? 250.60. This is trading 53 cents. So what if we bought 10 of these? That's $500. 500 bucks. Is it worth it? And when you think about it, like rationally, like there's not that likely that it's going to go above 250. However, we might, we will have plenty of money if it stops before then to finance this $500. So don't be put off of buying something because you're like, well, that's not that likely to happen if it's helping out your risk, right? Because that's the whole point here, is to help out our risk. And we can see, okay, up around, if we get to 250 here, we're only losing $1,400 as opposed to before where we were losing, let's see, what we were losing before. We can look at this like back and forth. So if we take this off, before we were losing, at 250, we were losing $3,000 with this. And hold on one second, 220, that's not what I wanted. We were looking at the 250, 260. I don't know why it got like that for 53 cents. So before we were losing, let's see, sorry. Before at 250 level, at the 240 level, we were losing 2,300. With this in, we're losing less, and if it gets higher, then we do better. So the question is what kind of risk is acceptable to you, and what is not? Maybe you feel comfortable with what you see, and you want to just leave it the way things are. It's all really up to your own risk tolerance with these things. So, but this is a great way to look at things visually, because a lot of people kind of understand things visually better than just kind of philosophically. Or, the other way to look at it is just these prices here, and then just kind of adjust. Okay, well, if I lost, if it was up for 35% or 30%, how much would I lose? Okay, I'd lose 3,700. If it was up 10%, you can go and reset these all to 10%. 10%, 10% doesn't look bad here. Okay, you lose $1,000. It's showing here, but you can see this theta number is pretty big, and that theta is probably going to cover that, right? But we can certainly see. I read something saying that the options are implying a 12% move. You can certainly see that as this moves from 10 to 20%, we start losing a lot more. So this is the big hole for me in this position, is this loss of, up 30%, and I'm just smoked, right? So up 40%, I'm even more smoked. So that's kind of like the concern right now for me. And this is even with buying those spreads. And without buying these spreads, and look, I lose $8,000 at 47%. Now, it's not that likely it goes there, but I don't want to have, even if it's not that likely, I don't want to have that exposure no matter how unlikely. I don't want to be in a situation where I can lose like half the account, right? So we need to plug up holes. You might say, well, it's not very likely that this or that's going to happen, but if you don't plug the holes completely, you're leaving that risk out there. And believe me, in the stock market, things that you don't think are likely to happen more often than you think they're going to. It's just kind of the way of the world. But yeah, yesterday we didn't really do all that much. one thing I did was I was short the 200 190 spread, and I rolled that down from the 200 190 to the 190 180. So we kind of moved it away. Stock did roll down 5 or 6 points yesterday, and in fact we had a low of 196. So moving away, I was kind of moving the downside away from the stock price as it started to move lower, kind of adjusting to the downside. And really, our downside is not a problem right now, right? Look, down 10%, we lose $400. Down 20%, we start to make money back, right? So really not a big deal, because we've got this kicker on the end here. If we did actually go to 100, we'd do awesome, right? Up $12,000. Now, usually when you have some spot you do awesome at, that spot's never going to happen. And, the other way we can deal with this is we can lean long into this. We could even buy some shares because the fact that we make money to the downside, we could try to lean long. So what if we were to go ahead and just buy some shares, right? What if we were to buy, let's say, 25 shares? Then that's going to start to, and no tears. If we go lower, we're going to lose $25 each point being long these shares, but we're managing our risk here. So if we were to buy 25 shares, now all of a sudden our risk profile, up at 250, we're down 1,800 as opposed to being down 3,000, right? So it all of a sudden it's evening things out to buy a couple shares, and that kind of makes sense. If you look at our delta right here, we're short 31. If we were to buy 25 shares, it's kind of flattening out the delta right here, and we're actually on the wrong day here. We should be on the 8th. So it shows a short 22 deltas here. If we were to buy shares and flatten out our delta coming into the close, that kind of it balances out our position a little bit. So that's something to think about. And other ways of getting long deltas are selling more puts. We do have this. The reason why we're making more money up here is because I bought some cheapo put spreads for like 50 cents, right? I bought the 150, 120 put spread for like 50 cents. And that's a very cheap put spread. It looks more like it would be better to buy the 160 put. What if we were to buy 160, 130 put spread? Let's take a look and see it. Look at that. And this is what I do. I sit here all day and I mess with, well, what if we did this? How much would this cost me? Blah, blah, blah. What if we were to buy one of these 160 puts and sell the 150 put? It'd be 55 cents. And that's going to help to flatten out that one little spot of risk, right? So if I bought two, it would be $100. And you can see it's already pulling this chart together. Now, it's showing no benefit at 160, but the thing is we do have still 1 day till expiration. This is showing on expiration. If we look at the purple line, that's showing what will happen the next day, right? Actually, that's showing today, but the next day will be somewhere in between these two lines. So the purple line is really more of an accurate representation of what's really going on here. As far as tomorrow, because remember, we can come in tomorrow and adjust the position. So the blue is like if we were to just like somehow be away from being able to trade until expiration, whereas the purple is a more kind of realistic P&L. If we look over here on the left, if I move out of the way, you can see purple represents today, the P&L, whereas the blue represents the next expiration, which is the 11th. So that's kind of some of the tools I'm looking at. I need to decide. I am bearish on this, so my position does reflect my viewpoint, which is I am bearish on this stock. I am positioning myself to make money if it goes lower. So your position should reflect your sentiment, right? if you're neutral sentiment, your position should be neutral. If your position doesn't reflect your sentiment, then why do you have it on, right? You need to ask yourself these questions. Do you feel comfortable with losing the amount that you could lose potentially if the worst happens? If you do feel comfortable with that, then when earnings come out, no matter what happens, there's no tears because your eyes are open and you understand your risk and you're accepting it. And that's kind of where we are. Anyway, so we'll see what happens moving forward. I will be having some more coverage of the actual VIX. I know people were asking for that. VIX, somebody was asking yesterday, would it be good to buy UVXY today? And UVXY actually did go up yesterday after that person was talking about that. So kudos to them if they did get long it. And it is kind of bid up a little bit today as well, even though the market is really not moving a whole lot. I did see some analysis of the market yesterday saying that basically Apple propped up the market. The market was all down except for Apple, and thus the market didn't really look like it was down because Apple has such a big market share. Anyway, so that's kind of where we stand coming into earnings. We'll see what happens. We have until the close today to place your bets before earnings comes out. And then after that, we'll just have to wait and see. We are expecting 67 cents. A loss of either 66 or 67 cents. There's a whisper number of like 45 cents. I was looking at this coverage on Thinkorswim. You can see in the live news there's like this earnings coverage. It's like what investors should expect, and it's got Gunjan Banjarai and another person talking about it. Unfortunately, Gunjan's a friend of mine. Unfortunately, I disagree with her tact here, which is it seems like these people on Fast Money and these CNBCs are courting the Reddit people, right? They don't want to say anything against the Reddit people. So she's throwing in these Reddit buzzwords like diamond hands, and when they question the other guy that was on there about what he thinks the valuation should be for the stock, he's unwilling to give it. And the reality here is that the valuation, if you crunch the numbers, this stock is way overvalued. But these people are afraid to say that because they're courting these Reddit people. They want those viewers, and they don't want to upset the Redditors because they know they're such a vocal group. But they need to have some integrity and stand up and say, yeah, this is way overvalued. It's bid up because of sentiment and this whole meme stuff. And I know that some of these people feel that way, but they're afraid of upsetting the Redditors, which is ridiculous, right? Have some intellectual integrity. All right, so there you are. And you can see Gunjan trying to like hang with the homies, talking about like diamond hands and all this stuff, and it's not real, right? So I don't agree with her on this particular issue. I suppose people who are friends with each other can disagree and be honest with each other, and I think it's ridiculous to just kind of court the Redditors because their valuations are just pie in the sky. People saying, oh, well, next up 200,000 and all this stuff is ridiculous. This stock is way, way, way bid up. Even great returns from this company, even if they're able to transform themselves into an amazing company, the stock still is at a lofty valuation. So, and it's still up 900% on the year or something like that. So that's kind of where I am. I don't like listening to that stuff, and I am assured this. I know that things will come back to normal. With the market, at some point, things come back to making sense. I don't know when that will be, but it's going to happen at some point, and hopefully I can hold out onto my short until such a time occurs. I did add to my January 190 put spread a little bit. Now, with the stock trading 210, I bought a bunch of these put spreads. I paid $2 with the stock trading 210, right? And then I kind of bailed out on them because I figured that I was paying too much. Now with the stock down $10, $11, I was paying $178 for the same puts, same put spread yesterday. Once again, this is the January 90-100 put spread. This is a volatile. When you have a way out of the money put spread, it is sensitive to volatility and vega, and it's showing on January 120 vol. If we isolate these options, they're slightly lower, but this spread can be worth up to $10, a valuation of $2. Unless we actually do get it move down before January, it's going to go out worthless. But I felt better accumulating it, paying 178 versus 198 stock than paying $2 versus 210 stock. So I'll try to chip away at accumulating more. If I could pay 160, that would be even better. I was surprisingly able to get out of the ones I paid $2 for around the same price I paid for them. You have this thing sometimes where like the algorithms that people are running, a lot of this market making is computerized now, and sometimes the algorithms kind of mess things up a little bit, and you can put an offer in just off the offer and you get filled. Sometimes the fills don't seem to make sense, and we see this across the board in stocks where sometimes these algorithms have these weird little wrinkles where they're gonna pay prices that don't make sense for stuff. And it usually happens on the harder to price options, the way out of the money options. And it was happening on this spread the other day where they were paying, a day before they were selling them to me for $1.90 with the stock higher, and then the stock down 5 points. I'm sorry, with the stock lower, it basically didn't make sense. The stock rallied in this put spread, which should have gone down, went up. And I was able to sell stuff out at a higher price than I bought it for, with the stock going against me. And when you see those little wrinkles like that, it could be just that they'd raised volatility in their models, but in this case, it seemed kind of strange. And if you can find those situations where like the computers are willing to pay you more than something's worth, you can take advantage of them. This is certainly not the only stock we've seen that in. I did see that in VXX when buying puts and trading way out of the money puts earlier this year. Anyway, so there we go. Thanks, Gigi, for your support and everybody else. And we will see you on the other side of earnings, I suppose. Thanks for watching. Bye-bye.